Hey everyone, I am Isha, and today I'm going to talk about the how revenue recognition and cash flow, these two chapters that we studied in the past 2 weeks, are kind of built on each other, because I remember professor saying something like that in the very start of the class and I made a note on it. So this is my subtopic. My main topic would be just making you guys understand the IFRS 15's 5-step model that we looked at to complete the questions that we did in class. So yeah, I'll just start. I have my speaker notes right here, so I'm going to look there. So yeah, that's me. Today, cool, I want to talk about those two chapters. At first, they feel like very different topics, but they are really dependent on each other. Cash flow shows what happens after we record transactions, while revenue recognition is about understanding sales transactions correctly before we record them. The main idea that connects this chapter is timing. The statement of cash flow tells us when cash actually comes in and goes out of the business. Revenue recognition, on the other hand, tells us when the revenue is earned. These two things do not always happen at the same time. Sometimes cash comes in first and revenue is earned, and sometimes it's the other hand, revenue might be earned first. Because of this, a company can show profit but still have cash flow problems. So this can be connected to the case study that we did in class, which was Enron. So yeah, that's like kind of statement that can make it easier to understand. This timing difference also affects the balance sheet. If a company receives cash before it has done the work, it cannot record the revenue yet. The amount is shown in as a contract liability, as it is an obligation to perform. If the company does the work first and gets paid later, it records revenue but not cash, which creates a contract asset or account receivable. To make sure revenue is recorded in the right way, so this is where IFRS 15 comes in. So this is my main topic today. To make sure the revenue is recorded in the right way, accounting standards give us a rule called IFRS 15. IFRS 15 helps us to decide when and how to recognize revenue instead of focusing on cash. So it focuses more on when the revenue is earned, I guess. It focuses on what the company promised to the customer and when those promises are completed. IFRS 15 uses a simple 5-step model to do this. So this is a 5-step model that we did in class to complete those questions. So I'm just going to maybe tell you guys about it in easier language so we can keep it in mind before midterm. The first step is to identify the contract. This step is about making sure a real agreement exists. Both the company and the customer must agree to the contract. The payment terms must be clear, and the company must believe it will actually get paid. If there is no proper contract, revenue cannot be recognized. Okay. The second step is to identify performance obligations. Performance obligations are the promises that customer makes in the contract. This could be delivering a product, promising a service, providing a service, or both. Sometimes this is only one promise and sometimes there are many. This step is important because revenue should be recognized based on what the company actually delivers. The third step is to determine the transaction price. This is the amount of money the company expects to receive for the contract. It is not always the same as the invoice amount. The price may change because of discounts, refunds, bonuses, penalties. IFRS 15 tells companies to use the amount they realistically expect to receive. So this is something that we did in the questions that we did in the class, so year by year. The fourth step is to allocate the transaction price. If there is more than one performance obligation, the total price must be split between them. This is done based on what each good or service would sell for on its own. This step makes sure revenue is divided fairly and not all recorded at once. So this again connects to the question that we did in the class, both of them. The fifth and final step is to recognize revenue when the performance obligation is satisfied. This means revenue is recorded when the company has done what it promised. Sometimes this happens at one point in time, like when a product is delivered. Other times it happens over time, like when a service is provided over several months or years. The most important rule here is that the revenue is recognized when the work is done, not when the cash is received. So yeah, taking you back to Enron's example, so they kind of recognize that the revenue in the cash flow statement when they earn the cash. So when they received the cash, but they did not really did the performance. So no performance obligation was done, I would say. In the end, this is why cash flow and revenue recognition are so closely connected. Revenue recognition decides when revenue appears in the financial statements, and cash flow statement shows when the money actually moves, when revenue is recognized correctly. The balance sheet makes sense and the cash flow becomes easier to understand. This is why understanding IFRS 15 helps us understand cash flow better. So the question that I have is, just a second, it's really simple. Okay, it's a really mini scenario. A construction company signs a 3-year contract worth 1 million by the end of year 1. The costs incurred to date are 300,000. Total estimated costs are 750,000. And cash collected from customers is 200,000. So cost incurred to date 300,000. Total estimated cost 750,000. And cash collected from the customer is 200,000. So I just want you guys to fill in the blanks. Percentage of completion would be dash percentage. Revenue recognized in year 1 is what? And if revenue recognized is greater than cash collected, the difference will appear on the balance sheet as what? So yeah, that's me.